Hey guys, David Robinson here. Welcome to the apartment investing journey. We've got another great episode for you today, another great guest. We have Will Harvey with us today. Welcome to the show, Will. Appreciate you coming on.
Hey, David, thanks so much for having me.
Yeah, my pleasure. So, Will, if you don't mind, why don't you start off and just give us a real brief synopsis of what your business looks like today and a little bit about yourself?
Yeah, absolutely. So I started out after I dropped out of college for the second time. I didn't know what I was going to do with my life, and I ended up going into the mortgage business. I had a family friend that was good friends with my parents, and he decided to take a flyer on me. No college degree, no life experience. I was 22. So I'm very grateful for that. So I started out in the mortgage business, learned it for about a year. I was chomping at the bit, wanted to get into sales. And then finally, after that year was over, I got into sales and had a good first year, good second year, good third year. And all the while I was purchasing residential properties in the Northern Virginia area outside of DC. And if anyone's familiar with that market, it's extremely expensive. And after my third rental that I bought, and they're all townhouses and they go for around 400, 500,000. So as you can imagine, I ran out of my own cash, and at the same time I was dealing with all the headaches that go along with managing single family properties, broken pipes and tenants calling you at 3 a.m., all that fun stuff. And I was kind of like, man, there's got to be a better way to do this. And I stumbled upon, I think it was actually Michael Blanc's podcast. And I started learning about apartments and just what that entailed. I was like, man, this is it. It just made way more sense. The economies of scale, the just how, when you buy a bigger property, it's actually easier in the sense that you can afford good property management and all that stuff that I'm sure you've talked about ad nauseum. So I started learning about it, and that was the end of 2018. 2019 jumped into it, and me and a few others formed a company, and we actually got involved on the active side of things for a handful of deals. And then I also started passively investing. Once COVID hit, we really stopped. We still have those active deals that we're in. We still update our investors, but we all sort of went separate directions. But I continued to passively invest, and I believe I'm in seven currently. One has gone full circle, and I'm happy to talk about that one. And there's another really cool one that just refinanced and returned all the investor cash. So yeah, so it's been fun. That's a quick synopsis of how I got into the apartment space.
Well, I appreciate that. And, our podcast is all about the journey. So we'd love to dig into some of this stuff. Let's back up to when you first started working in the mortgage business. How long had you been working in the mortgage business before you bought your first rental property?
I actually did a house hack before I was really making money in the mortgage business. I was just on a salary. I had my dad, a small salary, had my dad co-sign and bought a property. It was a 3-bedroom house. I lived in one room and then rented out the other two. And that was cool because it basically covered my mortgage, and I was building equity and wealth. And so that was the first one. Then I bought two more as I started to make decent money.
Yeah. So you bought those first three, and these are all in your market there. And again, you alluded to the price point being very high. So from a cash flow perspective, talk to us a little bit about the challenges of investing in that market.
Yeah, there's zero cash flow. They were pure appreciation plays. They were I was breaking even. I actually switched one of them a few years later to more of an Airbnb model where I rented out 2 bedrooms and then did one. It was a 3-bedroom townhouse, rented out 2 bedrooms on individual leases. And then I did Airbnb in another bedroom that was sort of separate from the rest of the house. And by doing it that way, I was able to cash flow about $500-600 a month on that one. But with that came a bunch of
All kinds
headaches
of,
and
yeah,
oh
management
yeah,
and
I mean,
challenges. Yeah.
Airbnb is like running a quasi hotel. So,
Yeah.
you're constantly having to change sheets and get people, toilet paper and food and all of that. And it's no fun. And for 500-600 bucks a month, it just wasn't, just
Yeah.
didn't
And
seem appealing to me.
And at that point in time, I mean, I know there's management companies that specialize in managing Airbnb. And so was that a consideration? But then it probably just cuts into all that cash flow. So really it could potentially just be a wash for keeping it
Yeah.
as a traditional rental versus Airbnb and having management in place.
Yeah, that's a great question, and definitely something I looked into, and you alluded to it. I just it would have eaten away at any potential cash flow that was there. So I just decided to kind of grunt it out and do it myself,
Yeah.
and wasn't fun. And then the market got hot at last year in 2020 and 2021, and I decided to sell them all.
Oh, did you? Okay.
Yeah,
Great. And
yeah,
so,
and I rolled it into
and
apartments.
yeah, and that had to have been okay. So this is a great conversation because this is a conversation we have with a lot of our brokerage clients, right? So anybody
Mhm.
that's bought, as many of our listeners know, I have a brokerage here in Utah, in Salt Lake City, in the Salt Lake City market, and a lot of what we do is working with individual investors that are buying small multifamily for their own personal portfolios. And a lot of our conversations that we have with our investors is, look, you bought this property, 5-7 years ago, 10 years ago, maybe even just 3 years ago, and the market's been so great here in Utah that you've accumulated a significant amount of appreciation of equity in these properties. The question that you need to be asking yourself is, what's the return that you're getting on the equity that's tied up in these properties, right? And so we help
Yeah.
them reposition that equity from, what they're currently in to potentially into multifamily. And so it sounds like that was your thought process was, look, I built up, I bought these at a great time in the market cycle. I've built up a significant amount of equity, and now what? What should we do with these? And talk to us a little bit about that
Yeah.
process for you.
Yeah, absolutely. I mean, you hit the nail on the head. I was looking at it and it's like, okay, this is yielding 500 bucks a month. That one property in particular, with the Airbnb, it's yielding about 500 bucks a month. It's a pain in the butt. I'm having to, run over there and get it cleaned and do all that kind of stuff. And I remember just having a conversation with my then fiance, now wife, and she was actually the one that had the idea. It's like, what are we doing with this? And I
Hmm.
think that part of it was I went into it with the mindset of, I'm going to buy this, I'm going to hold it for at least 5 years. And it wasn't quite 5 years. And the market just went crazy. And the amount of appreciation was, it did what I expected it to do in like 10 years,
Mm-hmm.
over the course of about 3.5. So it was fantastic. And I just looked at it. It's like, okay, on the one hand, I'm making 500 bucks a month and dealing with all these headaches. And I have this 100 grand or whatever it was, equity sitting in the house. Why don't I trade this in and roll it into and roll it into apartments where the cash flow is going to be greater. If I'm doing it from a limited partner standpoint, the cash flow is going to be higher than what I'm currently making, the cash on cash return. And also, I have to do nothing. I don't have to manage
Mm-hmm.
any tenants. I don't have to manage any tenants, termites, and toilets, as the great Grant Cardone says.
Yeah.
I'm
So
kidding.
yeah,
I kind of think he's an idiot. But
that's a great strategy, and a lot of
yeah,
our clients are deploying that right now. And so, just to get the timeline correct, you bought your first townhome when? Roughly what year?
yeah. The first one I bought in July 2016, and then the next one, the one I'm talking about with the Airbnb, I bought that one in um, December 2017.
Okay. Okay.
Yep.
And then you bought the third, and then about that same time, you started getting into the mortgage business in that what, roughly 2016 range? Is that correct?
Yeah,
2017?
I was in the mortgage business through all this, but it was
Gotcha.
this when I bought the second and third when I was making more money, and it was kind of like,
Okay.
I was watching my bank account grow, and it was like, what do I do with this this money sitting here? I had very
Mm-hmm.
low expenses, and all I really knew was single family. If I could do it
Mm-hmm.
all over again, and if I had the knowledge that I have now, I would have jumped straight into to multifamily.
Yeah, but I also think that there's a pretty good argument to be made that maybe, well, who knows, but you might not have ever got started, right? And the fact that
True.
you got started with that townhome and you built up a significant amount of equity in those, that actually gave you the ability to roll into multifamily and to be where you're at now, where you're almost exclusively passive investing at this point.
Yeah, very, very true. That's that. I mean, hindsight is 2020, 100%. And yeah, you're absolutely right.
I mean, I just think that there's a lot of conversation about going straight into larger multifamily, right? And I think that there's an argument for that for sure. But I also think that there's a place for people to just get started where they're at and take
Yeah,
action with what they know at that moment in time, right? And to your point, if you had known what you know now, maybe you would have started in large multifamily from the beginning. But you started where you felt comfortable, and that's great.
yeah, exactly. And I think that also I wouldn't have realized that that multifamily was so great, at least for me in my situation, if I hadn't have gone through the trials and all the headaches that go along with single family. So there's that aspect to it as well.
For sure. And just if anybody's not watching and they're just listening, you're a young guy. How old are you at this point?
28.
Okay, perfect. So not even 30 years old yet, and you're really moving into almost a strictly passive investing, role. Talk to us. Are you still working as a loan officer, or have you moved into investing full time?
I moved in at the end of 2019. I moved into investing full time. I let my licenses expire in the mortgage business, and I moved into this full time. I also have a partner, and we flip houses.
Okay,
So we
great.
do that as well, and that's sort of that's more active income. And
Yeah,
then, but my true passion and what I do with that active income is I deploy it into these passive deals, and
yeah.
the bonus depreciation is incredible. And you're basically able to, if you're a real estate investor, you can wipe away a lot of your taxable income legally by doing this kind of thing.
Yeah. So this is perfect. So you went from mortgages into investing full time. You got started as an active investor on a couple larger commercial multifamily deals on the GP side of things.
That's right.
And then you also added this flipping business where that's the majority of your active income at this point. Is that correct?
That's right.
Okay. And then you take that active income and you deploy that passively into large commercial multifamily syndications.
That's it. You hit the nail on
Okay.
the head.
Love it. So let's talk a little bit about your thought process then as it relates to investing as a passive investor in these type of deals. What's your framework for going about passively investing in multifamily syndications?
Yeah, that's a good question. I've learned. So like I said earlier, I think I don't know if we spoke on this before we started the podcast or not, but I'm in seven passive deals, and then one has gone full cycle. So I've done eight total, eight on the passive side of things. And what I've learned from doing those deals is that is first and foremost, far and away the most important thing is the sponsor. So the sponsor is the one putting everything together, and a sponsor can take a average deal and make it great. And they can do it the opposite way as well. If they're not so good and aren't very diligent, they can take a good deal and make it bad. And I've seen that, I've seen that happen. Luckily, none of mine have lost money yet. They've all been performing. But what I have seen and what I can compare from sponsor to sponsor is how some of them are extremely diligent with their communications and their follow up and just letting the investors know what's going on. And others, it'll 3 months will go by and I won't hear from them, and I have to text them or call them and just say, hey, what's going on with this property? Can you give me a quick, three sentence update on what's going on? And I think if you have to chase someone down, that's not a good thing. And if you're if you're trying to get out there and become a sponsor, communication is everything. There's no such thing as over communicating.
Mm-hmm. Love that. And so on the 7 deals that you've done, give us a sense of how many of those are with the same sponsor versus separate sponsors, and geographically where these are located.
Yeah, absolutely. So my recent, I think 3 out of my last 4 or 5 are with this one guy that I have 4 with total. And the reason is everything I just described. He's phenomenal. His name is Anthony Scandariato. His group is called Red Knight Properties, and he is so good about communicating and just letting us know what's going on. He's very good about under promising on the pro forma, and so far he's over delivered on everything that he's done. And even if he didn't, the fact that he communicates and the fact that he's just so good at keeping everyone informed is very good. What was the second part of that question? I forgot.
A geographic location.
Oh, yeah. So I'm in, I believe, 2 or 3 in Florida. 2 are in Ocala. 2 in Ocala, Florida, which is north. I believe it's north of Tampa. And then I have 1 in Tampa. 1 just recently sold in Mesa, Arizona, which is a submarket of Phoenix. And then where are the other ones? Emos, Pennsylvania. Or Emos, I don't know how to pronounce it. Lehigh Valley. Where are the other ones? Roanoke, Virginia. And then I think
so you have a pretty wide geographic footprint here. This is great. So moving forward as a passive investor, where we're at in the market and where you're at in your own business, do you see yourself continuing to invest with this same sponsor wherever they go? Do you see yourself branching out and investing with other sponsors? What's your sort of thought process moving forward?
Yeah, I plan to do all the above. There are other sponsors that I've got to know over the previous couple of years that I have not invested with, that when the right opportunity presents itself, I would. And then I plan to continue with some of the sponsors that I know. And then there are other sponsors that I've invested with that I probably wouldn't invest with moving forward. So really all the above. And I'm very bullish on multifamily in general moving forward. I've done 1 mobile home park deal. It's a fund that invests in properties all over the US, but multifamily in particular, I'm very bullish on. There's a shortage of about, depending on what report you read, anywhere between 4 and 5 million houses in the US. So it just seems like there's going to continue to be demand for apartments moving forward.
Yeah. And as you are, vetting a deal, are you putting more emphasis on the sponsor up front and then just more trusting the deal? There's a lot of talk about, passive investors, underwriting a deal and having key criteria they're looking for. What I find is when I talk with sponsors, actually what happens is once they may do some heavy due diligence on the first deal with the sponsor and make sure that the deal sort of checks their boxes. But outside of that, they're really trusting the sponsor. Is that what you're finding as you are investing passively?
That's exactly what I'm finding. And that's exactly what I do. So I like to align with sponsors where the structure of the deal and how they're compensated aligns with what I'm looking to do. So for instance, that one guy I mentioned, Anthony, that I've done 4 deals with, his structure is where he buys a property, a value add type of property, and he buys it where the rents are not where they could be. There's deferred maintenance, all that stuff. So he goes in, he cleans them up, updates the units, raises the rent, and then about a year after the acquisition, he looks to start shopping it for a refinance. And he's been very consistent on doing that. I have one that just a refinance that just closed in last month, a deal that I'm in with him. And I love that model because you get your refinance. Let's say that they return all the initial capital. I get all my money back, and I still maintain an ownership stake in the deal. So so moving forward in that particular deal, I'm playing with house money, and I continue to get distributions. It's lower because there's a larger loan on the property now, but I got my cash back. I can then deploy it into something else and sort of rinse and repeat and continue to compound those properties and keep the money flowing.
Yeah. Great strategy. And I love that mentality of refinance and roll. I mean, there's obviously a place for selling and exiting and moving on to another asset. But if you've got a good property that can cash flow and is in a good position moving forward for the next 4 or 5, maybe even 10 years, getting the vast majority of your equity back out, being able to put that against something else and stay in a deal and just receive distributions. I don't think it gets better than that. So.
I don't either. And I see other guys that like the quick, buy. And I have been a part of one where they bought it. It was sort of like an apartment flip. It was an 84 unit. It was that one in Mesa, Arizona, and it was purchased. It was rehabbed for almost 2 years. They cleaned it up, raised rents. There were some bad tenants in the property. There were actually, this is crazy. There were 9 sex offenders living in the property when it was purchased. Yeah. So that was on the PPM. So part of the the plan was to get rid of them and get in, get in new tenants and sort of rebrand it. And that's what they did. And they sold it just shy of 2 years. It was a phenomenal return, but it's sold, it's done. There's no more cash flow. Yeah. So, there's pros and cons.
Anything you were buying in Mesa 2 years ago is an incredible deal for the most part. So that's great.
Yeah.
Well, look, moving forward, what do you see on the horizon for your business? What does the next couple of years look like for you?
Yeah. So I was talking about this before we started. I'm actually starting a fund where people can more or less invest alongside me. I'm putting in at least 50,000 of my own money into this. So I want to show skin in the game. And then the plan is to go out and invest passively. I have performance. I've been doing this the past few years and have a decent strategy in my opinion. And there's no fees, no nothing. Everything is I'm incentivized on the back end. Once I return capital, only after that am I compensated. So happy to share more info on that if anybody is interested. But that's what I'm really that's what I'm working on right now. And I'm going to continue to invest in these deals. Like I mentioned, I am bullish moving forward. I don't know where, I don't do a ton in the stock market, but I stay pretty current with trends in the multifamily space, self-storage, mobile home park. And it does seem like there is, a decent amount of demand and should continue to be a decent amount of demand for these types of properties.
Yeah, I agree. And then I assume you'll continue working on your flipping business as well.
Yeah. So we're advertising on Google, selling our soul to Google and trying to do more deals there. So I can then take that and roll it into the long-term, the apartment stuff. So yeah.
That's a great strategy. Great
I
strategy.
appreciate it.
Well, look, Will, this has been a great conversation. I think it lines up with a lot of our listeners who, have played in the small rental property space, single family residential or small multifamily space, and are looking to transition to multifamily, large commercial multifamily, whether that be as an active investor or a passive investor. And so your story and seeing the steps that you took to get there is great. Is there anything else that I should have asked you about your business model that we haven't discussed so far?
I don't think so. I think we covered a lot of it.
Great. Well, let me a couple questions before we wind down here. The first one is, what's the biggest challenge that you're facing right now in your business?
Yeah. I would say that the biggest challenge is in the passive side of things. The biggest challenge is just, so I'm, like I said, I'm aligned with this one sponsor. He's fantastic. And I've really it's but he doesn't do a ton of deals. He's only doing good ones. And so I think that the one of the challenges finding other guys that do exactly what he does and are diligent, very responsive, and all of that. So finding great sponsors, that's what I'm having a challenge doing. I have those guys, but it's always you don't really learn until you place $25,000-$50,000 with them. And doing that, it's kind of a catch-22, because you have to trust them enough to do that. But only once you do that will you really find out if they're truly fantastic.
Yeah, I agree. What's something that you're absolutely crushing right now in your business that we could all learn from?
Man, I wish I would have looked at these questions ahead of time. I could have given this more thought.
That's all right. That's all right. I like them being off the cuff, because then you have to just sort of shoot from the hip and what's top of mind.
Yeah, I think that something that I'm ruthlessly introspective with what I'm doing, and I don't give myself a ton of praise, but I would say that the one thing that I did do when I first was starting out and continue to do is take action. I don't like talking about things and having grandiose dreams or anything like that. I would rather go out and learn by getting experience. Experience is the best teacher, and that's something that I've been able to consistently do. So
I love it.
That's
all too often. Yeah, no, that's great. That, taking action, all too often, we get stuck in a place of research and analysis and never take that action that's actually going to help us get to our goals. So congratulations. That's great. Well, look, Will, I appreciate you coming on. This has been a great conversation. What's the best way for our listeners to learn more about you and what you have going on?
Yeah, they can shoot me an email, will@harvey-capital.com. Or they can just go to the website, harvey-capital.com. It's I'm still tweaking it a little bit, but yeah, that's where you can find me.
Okay. We'll have a link to that in the show notes. Will, thanks for coming on. Thanks for sharing your journey with us. And I look forward to connecting with you again soon.
Awesome. Thanks so much, David.